Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 8th, 2023. I hope you're doing well. Appreciate you tuning in for my weekend review podcast. In this podcast, first of all, we're going to go ahead and run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have, both on the daily, weekly, and monthly charts. I'm going to talk about when I entered the trade, exactly why I entered the trade, what the signals were, and then, and most importantly, how I am going to manage the trade going forward, either getting out quickly if I'm wrong, second option if I hit my emergency stop, or if it starts going my way, then I start taking partial profits, wait until it gets to a certain trailing stop level, then the trailing stop level's in place. But I'll show you exactly how I'm going to manage all these trades, either the winners or the losers. Regardless, you just never know. All you can do is look for a confluence combination of indicators to line up to get you into the position initially, position size correctly based upon volatility and the value of your account. Know where your end of day stop is, know where your emergency stop is, know if it starts moving your way to take partial profits if it moves a certain amount from the previous bar's close. And like I mentioned, if we get to trailing stop level, then putting a trailing stop level in place to tighten up and reduce your risk. So do my very best to explain how I'm doing this. Hope this is helpful. Hope it's going to give you an idea of how I look at trading. But the main part of trading is looking for the confluence combination of indicators, giving yourself a good risk to reward ratio, position sizing based upon the volatility. And you have to have if-then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. You can't control the market, but you have to know exactly what you're going to do, regardless whether the market goes your way or against. All right, so we're going to take a look at all the positions that I have. It was a really good week, both long and short, and we'll go through all those. After that, I'm going to do a little bit on trader psychology and maybe some good trading words of wisdom. Always helpful for me to teach trading psychology because we all need it. That's the number one skill in trading, is the ability to sit patiently, wait for your signal, and then follow your process without getting your mind and your biases involved. It's very hard to do, and that's why trading is very difficult for a lot of people. But you have to stay open and fluid to the market either going up or the market going down and following your process. So we'll touch on trader psychology a little bit after that. I have gone down through my master watch list, both on the daily charts and the weekly charts, and I have identified some potential trades for next week. Now, these markets on these potential trades, they're not where they need to be. They have to come down, test, reject a level. If I'm looking for a long, they have to go up, reject a level to the upside if I'm going short. So the key is, when it's quiet on the weekend, I like to go through these charts, both dailies and the weeklies, and identify and go, okay, here's symbol XYZ. Not where it needs to be, but identify a level where I would take the trade. If it gets there and does what I need it to do, then I'm going to take the trade. Position size, everything I just talked about before. Could be a winner, could be a loser. I don't know. But if it doesn't get there, then I wait for another market on another time frame, or the same time frame actually, to get there. And if they get there, great. I'll potentially take the trade. If they don't, I'll just let them go, and I wait until a market gets to where I want it to be. That's the key. You have complete control over this, identifying a level and going, if it does this, if it gets there, it makes sense, I'll take the trade. All right, so I've identified, 3, 4, both on the daily time frame and the weekly time frame that I'm looking for. All right, and so that's going to be the format of the show, and I hope it's going to be helpful for you. So I have to run the U.S. legal disclaimer. Let's get that out of the way. It takes about 40 seconds. Hang tight, and I'll be right back. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through this with me. Boy, I'm looking at all my positions here. I have a lot of positions, but some of them are long, some of them are short. I've been getting short a little bit more lately. And also in this podcast today, I'm going to take a look at the indexes. I'll look at the S&P and kind of break that down, big picture of where I think the market's going. And by the way, when I go through these positions, I'll explain my process. I'll explain the rules. You might think to yourself, oh, Greg has a lot of rules. And I do. You know, I've been trading for 28, almost or over 28 years now. And through that 28 years, you know, I have developed about 5 different strategies that I use, and they all have different rules. So at first glance, it may seem like, oh, I could never remember those rules, but you can. And I just want to let you know that I do offer a private one-on-one stock trading course in the evening time via Skype. The course is 15 hours. It's one-on-one. It's just you and I. And in that course, I teach you step by step everything you need to learn to trade each one of these strategies. I've been teaching for years. I've taught people from all around the world, both from absolute beginners all the way up to seasoned hedge fund managers. And so if you are interested in really learning a skill, the skill of trading, I think the best way to learn it is one-on-one. So if you're interested, just send me an email. We can talk. The course does cost $1,750, but you get 15 hours of one-on-one instruction, and it's a great investment, and you'll have a skill that you can learn or use the rest of your life. And I'll talk a little bit more about it in detail closer to the end. But let's get going. All right, here we go. Lift. All right, lift. Oh, this is a wild one. I did get short lift all the way back here on the 9th of June. Remember at the beginning of the podcast, I said you need to wait for a confluence of signals, wait for your signals. Well, my signal, 2 signals. We went above the 70 RSI during the day and closed below it. That's one signal. The second signal is we had a V1, bearish V1 trigger to the downside. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes above bar 1 and then closes below bar 1's close. Okay, that's showing that the price went up here, was rejected, came back down, was even weak enough to close below the previous bar's low. I also use what's called V2s, but this was a V1. And by the way, if you'd like to learn more about V1s and V2s, just go to my YouTube channel in the lessons playlist. I have a video there called V1s, V2 entry triggers. It's totally free. And if you'd like to learn more about those, just go ahead and take a look. I think it'll be helpful. I get a lot of good feedback on that. And V1s, V2s are a big part of my trading. So entered short here, 1059, intraday rejection of the 70 RSI and a V1 entry to the downside. Now, when I take a V1, here I'm talking about those rules. When I take a V1, the key point of resistance above will be halfway of the V1 bar. See, this is the fuchsia pink line right here. You see how it's right below halfway of this washout bar, this V1 bar to the downside. So I entered here 1059. I position sized by taking 1% of my total capital, dividing by the value of the 2 ATR. That shows me exactly how many shares to buy. And then that's also my emergency stop, exactly the value of the 2 ATR above my entry. This is the red line. So just for example, let's just say we have a hypothetical $100,000 trading account. 1% of that is going to be $1,000. I would take $1,000 divided by the value of the 2 ATR. Then that's my emergency stop, the value of the 2 ATR exactly above my entry. So if it gets there, then I lose 1% of my capital. That happens very rarely, only about 5% of the time. 95% of the time, your end of day stop is going to come into play, and this is halfway of this washout bar. Now, in addition, so emergency stop, end of day stop, we have to look at the risk first. Then, if the stock moves, either up or down, whichever way I'm hoping that it moves, the value of 0.45 ATRs from the previous bar's close, I get out of 10% of my position. That's the offensive part. The emergency stop, the end of the day stop, that is the defensive part. But as it moves from a previous bar's close, the value of 0.45, I will always take off 10% of the remaining shares that I have. So that if it does go my way, I take a little bit, I lock it in, it reduces my position size, it mitigates it mitigates losses if it then turns back around. Okay, so got short here, 1059. V1 to the downside, rejection of the 70 RSI. End of day stop is any close above halfway, has to be the close. Place my emergency stop. Next day it goes down a little bit, but it didn't go the value of 0.45 ATR, so I kept the entire position. Next day it went above my stop during the day and closed barely below. You see how that's a key level, but still no profit targets. Next day moved down nicely, took 10% off. Next day up, tested the halfway bar again, but closed below, kept me in the trade. Next bar down, took some profits. Next bar down, locked in some profits. Also got to my 1.5 ATR trailing stop level here, which is 1.5 ATRs below my entry. Once I get there, then I go into trailing stop mode. Okay, so took a lot of profits here, 2 profit targets here. Next day goes down again. Locked in some more profits with a partial profit there. Now I'm in trailing stop mode, and then on this day here, the 22nd, I closed above a previous bar's close high, after reaching trailing stop. Then I took off half. All right. So at that point, I locked in half for a 3.21% profit. In addition, I locked in about 30% lower. See, that's the key. And then we move sideways, we move sideways, we move sideways. We have a big up bar, but it does not close above here. Next day, we have a big down bar, took more profits off the table. Next bar, we have another down bar, took more profits off the table. Up, up, up. Thursday, big down bar, took 20% more of what I had remaining. You see how I'm taking profits as the market's giving it to me? And then on Friday, we had a big up move. So anyway, the remaining shares that I have in this particular trade, on this particular short trade, are up 4.65%. But you can see, because of taking the partial profits on the big down bars, when on the big breaks, I've locked in more than that. Makes sense? So really good trade so far. Now, if we get down to a 35 RSI and then we close above the 5 EMA, I'll be completely out of the trade. If we go down further, reject the 30 RSI and then come back above, I'll take a remaining half. So these are all the rules. I know it sounds complicated, but it's really not. If you're taught correctly, and I do teach people correctly, very much step by step, but really great trade. And I like having some shorts here to help balance out. So the remaining position on lift on the short, 4.65%. Silver. Okay, what was my entry? My entry was back here on the 23rd of June. What were the confluences of signals? Well, on this particular day, we went below the 200-day moving average, closed back above. That's the main signal. We also went below intraday, the negative third ATR channel, closed back above. So confluence of signals, I liked it. What do? I position size by taking 1% of my capital, dividing by the value of the 2 ATR. That shows me how many shares to buy. I then place emergency stop, exactly the value of the 2 ATRs below, so that if it does go down there, then I know all I can lose is 1% most of the time, unless we had a big gap. Doesn't happen very often. And then where's my end of day stop? Well, my end of day stop is simply a close below the 200. See how it gives me a good risk to reward ratio? Then I place my 1.5 ATR trailing stop level up here. If it gets there, I go into trailing stop mode. Next day, moves up, took some profits off. Next day, moved up, took some profits off. Then we had a few days down. We went under the 200, but closed back above, kept me in the trade. Right? That's why I wait till the end of the day. Next bar moved up. Next bar moved up, took some profits. Next bar moved up at the open, took some more profits. Have not quite got to trailing stop level yet, so trailing stop level does not kick in. Thursday, we went down but held the 200. See how the market is respecting that 200-day moving average? That's the key. And then Friday, we moved up again, took some more profits. So been taking profits off as it's been moving up, and the remaining position that I have on SLV up 2.93%. So nice little trade there. Morgan Stanley. Morgan Stanley. All right, I did short Morgan Stanley back on the 3rd of July with an intraday rejection of the 200-day moving average. I got short here 86.52. I position size. I placed my emergency stop 2 ATRs above. My end of day stop is simply a close above the 200-day moving average. Again, if it starts moving down, I'll take partial profits. Very next day, moved down, took 10% off. Next day had a big bar down, took 20% of the trade off, locked that in, reduce the position size. Market can't take it away from me. And then Friday, we didn't do much, but I am at trailing stop level, which means if I have a close above a previous bar's high now, I will lock in half of the remaining shares. This particular trade currently up 3.77% on the short side. So great trade there. SPY. All right, this is a new position that I took on Friday, yesterday. This is an interesting setup, everyone, and it gives you it gives me at least some idea of the market in general. We have a lot of signals here. Let me kind of take you through this. You see the high we have over here? You see how high the green MACD bars were? It shows a lot of momentum. Then we pulled back into the value zone, pulled back to red. Then we have this rally last week where we got higher here than we got higher here. But you see how there's barely any green bars here? This is called a double top with a bearish divergence. This is what I learned from studying one-on-one with Dr. Alexander Elder. It just means that, yes, we moved up here, but it came on less momentum. Fewer buyers. The buying momentum is running out, and that indicates to me that we could be turning to the downside. Okay, so why did I take the trade? Well, I guess I should point out, look here in the blue highlighted box. This is called an island reversal. This is a very strong signal. Doesn't work all the time, but it's a very strong signal. Do you see how on this day here on the 29th we gapped up, leaving this big gap here? Then we move sideways, and then Thursday we gap down. So we have space here, we have space here. So these little islands are here by themselves. This is a bearish configuration. It means we had a lot of euphoria here, and then here it was, we had a lot of pessimism immediately. All right, so this is a bearish indicator just by itself. And then Friday we came up, we tested this, but failed. And in addition, what's the actual signal? Well, the signal is a V1 to the downside. Bar 1, bar 2. Bar 2 goes above bar 1's high, closes below bar 1's close. So double top, bearish divergence, island reversal, and a lower high V1 to the downside. And I want to show you, go back in time, I'll show you a bullish. This is an island reversal. This is a abandoned baby, but it's the same. Just multiple bars is an island reversal. One bar is an abandoned baby. See how we gapped down? And then the next day we gapped up, leaving space to the left, leaving space to the right. This is a bullish configuration. Boy, was that bullish. Well, now we have the opposite, folks. So I did take the trade with the lower high V1 after the double top, bearish divergence, and the island reversal. First thing I do is position size. I place my emergency stop 2 ATRs above. You see 2 ATRs above here, 807. Got short at 439.40. Place it exactly 807 above. So if it does get up there, I lose 1% of my capital. My end of day stop is halfway of the washout bar, the V1. So pink line here. If it closes above here at any time, I will exit the trade. That's it. Now, I have to place my 1.5 trailing stop level from my entry. 1.5 is value is 605. So go entry point here, 605. right here, just a little bit lower than that. This is my trailing stop level. So if I get to this trailing stop level, then I go into trailing stop mode, which means that if I have a close above a previous bar's high, I will get out of half. So got short here yesterday, 439.40. Right now it's 438.53, so in the money a little bit. So I like this trade, but it kind of speaks volumes to me about the market. This is a very strong bearish signal. I'm not saying that it can't go up. They don't always work, but they work more often than not. So seeing this double top here, this island reversal here, and the lower high V1 in conjunction with that, I like this trade. I don't know if I'm going to be right, obviously, but I like the setup for sure. All right, so those are the dailies. All right, I did have a couple small losing trades on the dailies that I closed out. I did buy GDX back here on the 29th of June, V1 to the upside, rejection of the intraday rejection, and close back above the 200-day moving average. So I got long here, 29.56. My end of day stop is a close below the 200. My emergency stop is here. My trailing stop is here. Next day moved up, took some partial profits. Next day moved up, took some partial profits, reduced my position size, which I'll show you it was very important that I did, and I hit trailing stop level. Then we have a close below a previous bar's close after reaching trailing stop level. So I took off half of my position for approximately a 1.05% gain. And then the next day it closed below the 200-day moving average. So I had to exit the trade here for a loss of 1.37%. But remember, I took partial profits here. I took partial profits here. I followed my rules and got out when I had a close below previous bar's low when it was a gain of 1.5%. So you see how the profit targets here, having my trailing stop level at a profitable level really mitigated the loss down here. If I would have just bought here and sold here, I would have lost a full 1.3%, 1.37%. But I lost much less than that because of taking the profits, because of taking profits, because of the close below the previous bar's close when it was positive. So that's why these rules are so important, everyone. But so anyway, the remaining shares that I had here, loss of 1.37%. And then FXY, oh boy, this one was a bummer. But, you know, that's the plus and minuses in the catch-22 of having rules. Sometimes you'll get out and then it will go right up where the way you want it to go, but sometimes you'll get out and then it keeps going down and you're glad. Well, this is FXY. This is Japanese, the Japanese yen. I've been talking about this. I did buy this back on the 30th of June when we had a close under and close back over the 200, the 30 RSI, and we also had a V2. Bar 1, bar 2, bar 3, bar 2 goes below bar 1's low, closes above bar 1's close. That was my entry, 64.50, and my end of day stop was simply a close below the 30 RSI. Well, next day, unfortunately, it closed below the 30 RSI. I got out for a very small loss, 0.31%. Next day kept under the 30. I could have gotten back in the trade here on Thursday when it went under 30 and over 30 again, but I didn't. And then look what happened. Massive move up, but that's okay. It showed that, you know, where I was picking the bottom was pretty close to where it was, but it did end up for a very small loss, 0.31%. But congratulations to the people that had FXY because it gapped up like a monster on Monday. All right, so dailies, just quick recap. On the short, on lift, remaining shares up 4.65%. On silver, remaining shares up 2.93% on the long. Morgan Stanley, short position up 3.77%. SPY, I guess there is a profit in this so far, up 0.18%. Closed out positions, GDX minus 1.37%, and FXY loss of 0.31%. All right, let's get to the weeklies. Boy, I have shown this trade. I have been in this trade. It's the longest trade I've ever been in my life. But it's a good example. These are weekly bars. I take the signal at the end of the week on Friday. Here we go. I bought this all the way back on the 14th of October, 2022. Why did I buy it? Well, Orange line here, 300-week moving average. We went below the 300, closed above the 300. I got long 167.19. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. And then, of course, if it starts moving up, I take profits. So I got long 167.19. Next week, moved up, took some profits. Next week, moved up, took some profits. Next week, got to trailing stop level. Next week, took some more profits. Then we went sideways. Then here we had our first close below the previous bar's low after reaching trailing stop level, locked in the remaining shares I had for 6.53% gain. Then we headed back down, but then we had another huge move up where I took more profits here, I took more profits here, I took more profits here, consistently reducing my position size on strength. And then we had a couple months of downwards movement. I thought it was going to close below the 300, which would have gotten me out of the trade. It did not. It's respecting this 300-week moving average, move sideways, move sideways, move sideways, but held on a closing basis, the 300. Then we had another nice week up, took some profits, had another nice week up, took some profits. Here had another nice week up, took more profits, continually reducing my position size. So the remaining shares that I have on IWM on this weekly trade, up 9.61%. XLF, all right. I purchased and went long XLF back here on the 24th of March. What was the signal? The signal was the rejection of the bounce essentially here at the 250-week moving average. Got long 30.71. Position size, placed my emergency stop 2 ATRs below, placed my 1.5 ATR trailing stop level 1.5 above. Next week moved up nicely, took some profits. Next week, nothing. Next week moved up, took some more profits. And now I am in trailing stop mode. Sideways, 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 looking for a close below previous bar's low. Didn't happen. It happened 3 weeks ago here when we had a close below the previous bar's low. Locked in half of the position at a 6.4% gain. And then next week moved up strongly, took some more profits off the table. And so the remaining shares that I have on this weekly long XLF trade up 8.49%. Pretty sweet, right? XLRE, all right. This is what's called a higher low V2. I teach this in my one-on-one course. Higher low means that you see the two green lines here. This is the value zone. The rules for this is that you first have to close below the value zone. You have to rally into the value zone. You have to have a pullback, and then you have to have a V1 or V2 trigger. Well, this is a V2 trigger, consists of 3 bars. Bar 1, bar 2. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Got long here, 36.32. End of day stop is a close below halfway of the washout bar here. Here's my emergency stop here. So it's just simply, if it closes below halfway of the washout bar in the V2, I get out. Well, next week, move up, took some profits. Next week, moved up, took some profits. Then we had a big reversal bar. You see how it came right to that halfway but held? Shows you that those halfways command respect. And so if this had closed below, I would have gotten out, but it didn't. It held. Next week, opened, tested it again, moved up strongly, took some more profits. This week moved up, not enough to take profits. 1.5 HR trailing stop level here, have not reached that. Once I reach that, then I go into trailing stop mode. So it's been a really nice trade so far. On bars that moved up strongly, I reduced my position size, locked in profits, and the remaining shares that I have here up 3.92%. All right, so just quick recap on the weeklies. Remaining shares on the IWM long up 9.61%. Remaining shares on XLF up 8.49%. Remaining shares on XLE up 3.92%. And then last but not least, everyone, monthly bars. This has been a monster trade. Really, really, really. This has been one of my favorite trades, and it's worked out really well. Monthly trades you take on the last day of the month. Well, what was my signal? Look at the 200-month moving average, the black line. We went below it, closed back above it. Gave me a very good risk to reward ratio. You can see even in the past 3 months, it tested the 200, closed above. Tested the 200, closed above. Tested the 200, closed above. The reason I bought it here was because it's so close to the 200, it gives me the best risk to reward ratio. Placed my emergency stop 2 ATRs below. My end of month stop was simply going to be a close below the 200. Placed my 1.5 ATR trailing stop level up there. Next month was a monster. I took off 2 profit targets because it moved 0.45 ATRs from the previous bar's close twice. First profit target here, first profit target here. So I've taken off 20%. This month moved up nicely, but not yet the value of 0.45 ATRs. And now, most likely with this trade, I will be getting out before earnings. Earnings is on the 27th of July. I never hold through earnings. So the day before earnings happens, or the night before, or the morning before, depending on when they have earnings, whether in the morning or the evening, I will just exit the position regardless of anything else. And I don't ever hold through earnings. It's a big gamble. It's a big risk. I mean, next week, if we close below 200, I would get out, obviously. I think that's very unlikely. This particular trade is a monster, up 21.07%. So anyway, I hope that was helpful. You can see it's worked out very well over the last month, or more than that, with these particular trades, both to the long side and the short side. But I do, again, want to caution you. I'm not predicting this, but I'm just looking at the evidence here on the S&P of a double top bearish divergence island reversal bar. We tested it, failed, and we have the lower high V1 to the downside, and that's why I got short on the SPY. But this is a bit of a warning sign, everyone. All right, so those are the positions for this week. Let's talk a little bit about trader psychology. This is from my good friend and mentor for years, Steve Burns. You can follow Steve at S. Joseph Burns over on Twitter. Really good illustration here of profitable trading, and it's a pyramid. 10% is your strategy. 30% is your money management, 60% of importance is your psychology. And that's why I was talking about how important it is, the psychology part. Everyone thinks that the strategy is the most important. Man, if I just found that strategy that worked for me, that's a very small part. Steve has here at 10%, because yes, strategy is important. Technicals are important. Entry signals are important. But if you don't follow your strategy, then what good is it? And following your strategy comes down to your psychology of being able to follow the rules. Money management is extremely important, and position sizing based upon the volatility of the market is extremely important. I don't know a lot of traders that position size based upon the actual volatility, and it's very easy to do by taking 1% of your capital, dividing by the value of the 2 ATR. That factors everything in. In the recent past, what has the market been doing? What's the volatility? If volatility is higher, just that simple rule is going to make you buy or short fewer shares. If it's lower, then you're going to buy or short more shares, and that's the way it should be. So strategy, yes, it's very important, but it's only as good. Your strategy is only as good as the person implementing and executing the strategy, which comes down to psychology. And money management is hugely important, but the 2 ATR rule and position sizing based upon volatility, it solves so much of that. And your money management also includes your end-of-day stop, your emergency stop, taking partial profits, as I've discussed many times today in this podcast. But psychology is the most important part. Get yourself a process, get yourself a plan that has if-then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. That is hugely important. Most people don't know. They're just, I'm just kind of gunslinging. I guess this is enough. I guess this is enough. You know, I've worked with hedge fund managers who have told me, I kind of need a plan. I need some levels in a plan instead of just, hey, I think I'm going to do this. I think I'm going to do that. Right. So get your process down. I can help you with one. If you decide to become my student, I'll show you exactly the plan I use, everything that I use. But psychology, extremely important to follow your plan. Money management, position sizing, very important. Strategy, important, but it's the least important. The psychology is the most important. So here's the pyramid for profitable trading. Get yourself a good strategy. Get yourself a good money management system and plan. And then under the psychology, important 60%, most important, to follow this, to follow your strategy and to follow your money management. That comes down to psychology. So hope that was helpful. And thank you, Steve Burns. Please follow Steve over on Twitter at @SJosephBurns, or you can also follow Steve on Facebook at New Traders, Rich Traders. All right, so I have 4 potential stocks on the daily time frame looking at next week. Now, as I just mentioned, they're not where they're supposed to be yet, okay? So when I look at Home Depot HD, the 200-day moving average would make a lot of sense because the 200-day moving average is kind of a magnet, and it's where large financial institutions and savvy traders will come in. So next week, if and only if Home Depot moves down and has some kind of rejection, either it bounces at the 200 or it goes below it during the day and then closes back above. That's another option. Or if we close below and then close back above, that is what I'm looking for. So I'm looking for some kind of rejection to set up my trade of this 200. If it goes below the 200 on Monday, for example, and then closes barely back above, it gives me a very good risk to reward ratio, right? Then I'll position size correctly, take the trade. Then I have that line in the sand, the 200-day moving average. If it simply closes below, even by 1 penny, boom, I'm out. Right? Of course, I placed my emergency stop 2 ATRs below. But these lows over here were rejected, moved up, and or the 200-day was rejected and moved up. So it doesn't mean that it will happen this time, but it will certainly give a good risk to reward ratio and a level to key off of with some kind of rejection of the 200. But I'm not interested in buying it here right now. Potentially, if we move sideways here in the value zone for a couple days and then had a V1 or a V2, that's called a return to value V1 or V2. That would also be, but it's kind of hard for me to predict that that's going to happen. But again, this is what I teach in my one-on-one course, our return to values, sideways motion, then a V1 entry. So that would also be a potential, but for the purposes of this podcast today, very easy level to look for rejection is the 200-day moving average. So Home Depot, some kind of rejection of the 200-day moving average next week, I would consider taking this trade. Nike, well, Nike, oof, boy, what do I do with this? Well, look, the RSI is at a 35.73. If and only if next week we go intraday below the 30 RSI, then close above the 30 RSI, or alternatively close below the 30 RSI and then close above it, that would give me a good risk to reward ratio, would give me a good level, the 30 RSI level to key off of, and that's what it's about, right? That's what it's about. So if and only if next week we have some kind of intraday rejection of the 30 RSI, or alternatively a close under 30, over 30, I will consider buying Nike long. TLT, same. This is amazing. Look at the sell-off in bonds in TLT, 20-year bond. The more this price goes down, the more interest rates go up. So it's very strange to have a market that's going up, 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 and a bond market that's going down, 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 down. Very interesting. But what am I looking for as far as potential entry? Same as on Nike. Under 30, over 30. Right now we're at 35.87. If and only if next week we have some kind of intraday rejection of the 30 RSI, or alternatively a close under the 30 RSI and back over, I would be interested. So why the 30 RSI? Well, the 30 RSI is an extreme oversold level, and I want to see the market reject that level and say, okay, enough's enough. We don't want to go down anymore. That would be my entry, and it gives me a good risk to reward ratio. VIX. Well, VIX is the volatility index. Usually if the market moves down, the volatility index, or the VIX, is going to move up. We have been in this historic sell-off in VIX. The market's pricing in basically there's not going to be any more volatility ever in the history of the world, which is wrong. Of course, we're going to have volatility in the market, in the world, and the VIX should respond. You can see here we have a double bottom bullish divergence. Here's the low, here's this low, deep red MACD bars. Then we rallied into some green. We came lower, but now MACD is positive, which is ironic because if you look at this chart, nothing looks positive about it. But you see how we had this leg down, then we kind of consolidated, move sideways, move sideways, move sideways, move sideways, while we have the positive MACD and the price was compressing. I had a feeling at this point we were either going to have a big down move, one more down move down, or we were going to explode to the upside, and that's exactly what happened on Thursday. Look at this. We gapped up higher. We went way high. We sold off, gave a lot of it back. But this is what I'm looking for on VIX. You see the gap here, the high of the gap, the lower bar, and then the gap here. Well, if we come back this next week and test the gap closure here, if we close the gap here and reject it, meaning that we go under it and then close back above it, I will get long the VIX. My stop will just be a close below here. I think things have changed on the VIX. We had a trend line that was broken substantially to the upside. Does not surprise me at all to have a little bit of a backfill because the people that bought here had this huge gain, and so it makes sense that there would be some backfill people taking profits. But me personally, I think the end of the VIX move down has happened. And this backfill doesn't surprise me, but I am looking to get long VIX next week if we reject 25.26 and then close back above it. That will show me that the gap has been filled. And people that wanted to take profits took profits, and it gives me a good risk to reward ratio. So that's what I'm looking for on VIX. So quick recap, Home Depot, I'm looking for some kind of rejection of the 200-day moving average. Nike and KE, looking for it can continue lower, looking for an under 30 over 30 for potential entry. Bonds, TLT, I'm looking for an under 30 over 30. And VIX, I'm looking for it to come down, fill this gap, reject the gap 25.26, and then close back above it. That would be my entry. So hope that's helpful. Let's go to, oh, I should say, by the way, look, theoretically, all of these positions on the daily next week could trigger on the same day. But that does not mean that I'm going to take every single trade. I like to limit myself to one trade per day. And so if these all hypothetically triggered next week, on the same day, I would just go in and look for the best one. And what do I mean by the best one? The one that has the most confluences of signals, the one that looks the best on multiple time frames, the one that has the best risk to reward ratio and structure, right? And again, you might think, well, how do you do that, right? Well, if you really want to know in detail, take my one-on-one course. I will teach you all of these things and how to narrow down to the very best one. It's kind of like a treasure hunt at the end of the day. I've had days where I've had 5 or 6 potential entries. Which one do I take? Well, what's the risk to reward ratio? Confluences of signals. How do they look on multiple time frames? What's the market structure? Make sense? All right, so let's go to the weeklies. Hey, by the way, if you are enjoying the podcast today, I would really appreciate it if you could just hit the thumbs up button. Helps build the channel, helps keep the channel around, lets YouTube know there's some valuable content here. So if you're learning anything helpful today and useful today and valuable today, all I ask is that you just hit the thumbs up button real quick. Okay, weekly. Again, weeklies close on Friday. I will be looking for this next Friday. This is Salesforce CRM. 200-day makes a lot of sense. And you see the highs we have over here? These were resistance, and then we broke out above them. Now these become support, right? Once you break above resistance, then that resistance becomes support. Well, you see, and I drew the level of the support level here of the previous resistance, and that dovetails really nicely with the 200-week moving average. So this would be a great trade. It would come inside the value zone. It would give a very good risk to reward ratio. So if next week and only if we come down intra-week, go below the 200, but then close above it, or we bounce at the 200, that would be my signal to consider about getting long CRM. Again, because of the rejection of the 200, which dovetails with the rejection of this previous high here. But if it doesn't get there, I just let it go. Not going to chase it. You just have to let the trade come to you, everyone. You have to identify the levels that make sense and go, okay, here's the level. If it gets there, I'm going to take the trade. If it doesn't get there, I will just go on to another market. So CRM next week, some kind of rejection of the 200-week moving average with a good risk to reward ratio. That's what I would consider. Nike. Do you notice how I had Nike on the daily as well? Well, I also have it on the weekly, which is interesting. I always like when I have symbols show up both on the daily and the weekly. It's showing me there's some important levels on both time frames. Well, look, I could have bought Nike Friday, but I didn't. Why? Well, do you see the orange line here? This is the 300-week moving average. It did not get to it. If it had got to it and bounced up there, I would have considered taking the trade, just like I did on Russell 2000. Very similar. I had that great big trade off of the 300-week moving average. If it gets to the 300-week moving average, things are pretty low. I don't think Nike's going out of business. They're just out of favor at the moment. So next week, what I'm looking for on Nike would be the market testing the 300 and then closing back above nice and gently, so it gives me a good risk to reward ratio, or alternatively, the price of Nike going below the 300-week moving average and then closing back above it, giving me a good risk to reward ratio. So that's what I'm looking for on Nike. And last but not least, Pfizer. Wow, Pfizer is, I mean, look at this chart, everyone. That's horrible. Horrible, but gives a good opportunity here to maybe get long Pfizer. First of all, let's take a look, see what's going on big picture. Here we have a low, here we have a low. This huge move down. You see the deep red MACD bars. This is just showing that there was a lot of downward momentum. Then we rallied. We had a short-term rally where we went green. Now look at the price. Are we lower here than we were over here? We are, by far. But look at the red MACD bars. Not very deep, are they? This is a double bottom with a bullish divergence. This is a positive structure from a momentum standpoint. Look at the RSI. Look at this low here. RSI was way under 30. Now we're lower here, and we're not under 30. So what we have here is called a double. We have an. Whoa, lost my headset. We have an RSI divergence. So we have a MACD divergence. We have an RSI divergence. These are all very bullish developments. But you look at this chart, it doesn't look bullish at all, right? But from a MACD perspective and RSI perspective, it is bullish. But I still need a trigger. So what would my trigger be? Well, look, we're 3166 RSI. So next week, if we bounce at the 30, close back above, or we go under the 30 RSI, close back above, then that would be my signal, especially because it comes in conjunction with this double bottom bullish divergence, double bottom bullish RSI divergence. Just need a trigger. I think this is a very good opportunity, but only if it triggers what we need. So just a quick recap on the weekly. CRM, I'm looking for a rejection of the 200-week moving average. Nike, looking for a rejection of the 300-week moving average. And Pfizer, looking for a rejection of the 30 RSI. Again, these could all happen on the same week. If they did all trigger on the same week, I would just have to narrow it down to the very best one. So at the beginning of the podcast, I talked a little bit about that I do teach private one-on-one lessons in the evening time. I love to teach. I'm a good teacher. I will teach you all 5 of the different trading approaches that I have been using for the last 28 years. They're very valuable setups, and I believe that having a one-on-one teacher, taking lessons one-on-one is the best way to learn anything, and I will take you through all of them. It's 15 hours, 5 sessions. Each session is 3 hours long, a total of 15 hours. We do lots of simulations. I teach you each lesson, and then after I teach you what I'm teaching you, then you basically have to teach it back to me so that I know that you know it. And we go through all sorts of examples. We just pick random markets, random time frames we go through, and then you start to drive. You're going to start teaching me. You're going to show me the trades. You're going to show me what you're going to do. I really think it's the best way to trade. Like I said, the price is $1,750. It's worth every penny. You're going to learn a skill you have for the rest of your life. So if you're interested, all you have to do is send me an email. The email is in the link of this YouTube video. If you do send me an email, I'll reply and say, hey, thanks for saying hi. Let's set up a Skype call. The Skype call is free. It's not a sales call. I promise you, you don't have to worry about that. I just want to learn more about you, your trading challenges, your goals, and it's a great time for you to ask me any questions about the course and the format of the course. And when we're done with the call, then it's all on you. If you're interested in the future and you want to set up and book the course, then you just reply to me and say, Greg, I'm ready. We'll set a time and a date and we will get started. Number 2, if you like online courses, I have a great online course available at udemy.com. The link is in the description. It's very affordable. It costs between $12 and $15, and I teach you not all 5 trading approaches, but I teach you the deep dip buy stock trading approach, and a lot of what we've been talking about, the positions that I took this week that I showed you, a lot of those were deep dip buy. It's a great way to get started. It's not as great as or as good as the one-on-one, but it's a good, affordable way to get started. And the course is 9.5 hours of video, 26 videos, 15 study guides. And I've got so many good reviews and feedback from that. So the link's in the description if you're interested in that. Just a few minutes ago, I mentioned if you like today's podcast, I would really appreciate it if you could get out there and share it and or hit the like button, or both would be great. And most importantly, as always, please try to go out, do something nice for someone today. If we all did one nice thing for another human being, the world would be a better place. Of course it would. It just makes sense, right? If we all did one nice thing. And if you could also go out and do one nice thing for an animal today, I would really appreciate that. Animals appreciate acts of kindness. I was raised with animals as a child, and I know they do. And so, if you like this podcast and you appreciate what I teach here, all I ask is for a like. You go out and do one nice thing for another human being and one nice thing for an animal. So I hope you enjoy the rest of your weekend. God willing, I will see you next week, and we'll see what's happening with this crazy market. But if you have any comments or questions, put them in the comment section. I'll do my best to respond, but hope you have a great rest of your weekend. Get out, do some exercise, study your charts, prepare for next week. But I appreciate you being here. I really do. And like I said, God willing, we'll see you here again on this podcast next week. And on the way out here, I have to run the U.S. legal disclaimer. All right. Have a good rest of your weekend, everyone. Appreciate you being here. Bye-bye.
U.S. government stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.